Hey there, welcome to How Taxes Can Make You Wealthy. My name is Lisa Corbett, and I've spent the last 25 years of my career teaching hundreds of entrepreneurs how to permanently reduce their taxes by 10, 40, 50, 60%, sometimes even more legally, and it's not that difficult. It's a matter of understanding what the rules are and how the rules can apply to your situation. Today, we are going to dispel many common myths of the tax code, and you're going to learn how to massively reduce your taxes so that you can build massive amounts of wealth so you can reach your dream. Whether taxes make you rich or make you poor is completely within your control. Taxes can either deplete your wealth or help you build wealth. Every transaction you do can have an impact on your taxes. So it's important to think about those in a way that gets you to your goal of permanently reducing your taxes. Most people are all for permanently reducing their taxes, of course. What is typically missing in their quest to do that is the strategy piece. And it's the strategy piece that produces the maximum results. The strategy piece helps focus our actions and thoughts every single day on permanently reducing taxes. You have the power to significantly influence how taxes will impact your wealth, and the tool to help you do this is a tax strategy. What is a tax strategy? First, let's start with what a tax strategy is not. A tax strategy is not about loopholes. Loopholes are unintended consequences of laws that were enacted. A tax strategy is about the consequences that lawmakers intended. A strategy is a systematic plan of action to help you take advantage of those intended tax benefits. Remember, the tax laws of all countries are written to encourage certain activities that benefit the economy and promote social policy. It's our job to understand and take advantage of those tax laws as they are written. Today, I want to share two very important rules that are the foundation for reducing your taxes legally. Rule number 1, it's your money, not the government's. Rule number 2, the tax law is written primarily to reduce your taxes. So the bottom line is the government wants you to reduce your taxes. The tax laws in most developed countries are written to reduce your taxes, not to increase them. In the U.S., for example, there are over 5,800 pages of tax law. Only about 30 pages are devoted to raising taxes. This leaves over 5,700 pages that are devoted entirely to reducing your taxes. This means 99.5% of the tax code exists solely for the purpose of saving you money. I even go as far to say it's actually your patriotic duty to reduce your taxes by all legal means. Most people think I'm kidding when I share this, but I'm not. Think about it this way. If 99.5% of the tax law is written to help you reduce your taxes, then the government must really want you to do just that. Otherwise, why would they enact so much legislation aimed at helping you do so? All of the so-called complexity of the tax law is really just aimed at reducing your taxes, not increasing them. When I share this concept with others, they usually find it interesting, which is great, but I really want them and you to think about this concept and how to apply it to your personal situation. We've got to take the fear out of taxes. Once you truly believe that the government wants you to reduce your taxes, you'll realize that you have the right to reduce your taxes every minute of every day. All you have to do is learn the rules. Many people fear taxes. They view them as a necessary evil that prevents them from getting ahead and keeps them from building the wealth of their dreams. Surprisingly, some tax professionals feel the same way. It is key to have a tax advisor on your team who understands what it is the government wants you to do in order to reduce your taxes and, more importantly, is able to put those rules in terms you understand. The tax law is like having all the answers to the test. The tax code is literally a roadmap to wealth. If you're willing to educate yourself, you can legally capitalize on it, even if you're not rich yet. And despite what you've heard, taxes are fun if you like money. One deduction that saves you $3,000 per year, invested at a 10% interest, means over $500,000 over 30 years. That sounds like fun to me. Most people view taxes as a drain on their wealth. If it weren't for their taxes, they would have more money in their pocket, would finally be able to get ahead, and could start investing. I look at taxes very differently. I look at taxes as a way to increase your cash flow. The tax law provides tons of opportunity to reduce your taxes. And when you reduce your taxes, you increase your cash flow, often immediately, which can then be used to increase your wealth. Reducing your taxes goes hand in hand with your wealth strategy. For most people, taxes are their single biggest expense. This means that reducing your taxes results in instantly increasing the amount you have available to invest. Remember, the government wants you to reduce your taxes. The tax law is a series of stimulus packages for real estate investors and business owners. This is true in all developed countries. The government wants to provide jobs and housing. To encourage others to do this for them, the government provides tremendous tax benefits to those who provide jobs, business owners, and to those who provide housing, real estate investors. Use your tax strategy in your wealth strategy. And once you understand what the government wants you to do in order to reduce your taxes, you can use this information in your wealth strategy to invest in assets that not only fit with your wealth goals, but also produce tax savings. This is a powerful formula and the one that can be used over and over and over again because many of the tax savings for entrepreneurs and real estate investors are annual tax savings. Then, as your wealth grows, so do the opportunity for tax savings, which means not only does the cycle continue every year, it grows every year as well. So your tax savings are more, your increase in cash flow is more, and your wealth increases even more. Do you see why I'm so passionate about taxes? Taxes are a tremendous tool to build your wealth. A tax strategy is more than just wishing you could pay fewer taxes. A tax strategy ensures you pay the least amount of tax allowable by law, regardless of your business or investment situation. I'm often asked what is involved in creating a tax strategy. When it comes down to it, there are 3 critical pieces to start with when creating a tax strategy: your wealth vision, your entity structure, and deductions. Begin by identifying your personal and financial goals and dreams. I call this your wealth vision. Where you want to go has a significant impact on how your tax strategy looks today and how it will grow with you. A successful tax strategy takes into account your goals for your business, your investments, and your family. Never create a tax strategy that does not fit with these goals. The very first thing we have to do is to determine what is that dream. What is that you're doing this for? Because we all need a motivation to do what it takes in order to get where we're going. So we're going to start with learning how to dream. We're going to start with an exercise, and here's how the exercise goes. We're going to dream, and what I want you to think about is that place that in your mind, if you had no concerns about money and no concerns about time, that's where you would be. Imagine how you're feeling in this place. What are you feeling in this perfect location? Who are you with? What are you feeling having them with you in this ideal situation? In your dream, with the people that you love, the people that you want to be with more than anyone else in the world, what are you doing? How does it feel to be doing these things with these people in this amazing place, in these amazing surroundings? I want you to write down exactly what you saw and exactly what you felt in your dream. Where are you? Who are you with? What are you doing? And how does that feel to actually realize your dream? Now, I want you to write down one more thing. When would you like to achieve and reach this dream? Is it 5 years out, 10 years out, 20 years out? What's your idea of when you'd realize this dream? Well, it may not be tomorrow. When will it be? It's very important for us to get clear and focused on what it is we want. That's where our energy will go. Why is it important for you to reach your dream? Why do you care about it? And what will this mean to you? And what will this mean to your family? The second critical piece is your entity structure. Review how your business and investments are currently held. Then determine how they should be held, both now and in the future. Should you change the type of entity or entities that you currently have? Should you add entities to take advantage of tax savings available to certain entities? As you are creating your entity structure, keep this in mind. Your entity structure must be flexible because your entity structure will serve as the basis for tax savings for the rest of your life. Entities are the backbone of a tax strategy. An entity is like an artificial person used to distinguish and set up a type of organization or company. Whether you're running a business that sells a service, a product, or running your real estate or stock options investment operation, it is extremely vital to set up the correct entity structure. This can affect how much you pay in tax and determine your legal responsibilities, your personal responsibility, in the event of a lawsuit or legal matter. There are advantages and disadvantages for each type of entity, and the liability and taxation for each also varies. A tax strategy is very personal because each situation is quite different. One of the big mistakes that people make is to set up their entity structure similar to a neighbor or a business associate. You want to make sure that you research and understand the best options that fit within your personal circumstances. It is so important to discuss your affairs with your tax advisor and your attorney. You want to ensure that you are taking advantage of the laws that are available to you by establishing the correct structure to fit your personal situation. Some factors to consider when selecting your tax entity. There are a few key factors that can guide you when selecting your entity. Those factors are the type of income, the use of business income, and the amount of business income. Let's look at each factor. Factor 1, type of income. Will the type of income generated be business income or investment income? Investment income is based on time. Investment income examples include real estate that is a rental and is based on time, so the income is investment income. An asset held long-term generates income based on time, so the income is investment income. Investment income usually involves appreciating assets. There are assets that tend to increase in value over time, like real estate or paper assets, so the assets are held for a long period of time. If there will be investment income, then consider one of the following entities: a sole proprietorship, and here you want to use this if there's only one owner; a partnership, and you want to use this if there's more than one owner. So sole proprietorships and partnerships provide tremendous flexibility to move assets in and out of the entity without triggering tax, whereas taking an appreciated asset out of a C corporation or an S corporation can trigger tax. With business income, it's based on effort. Business income examples include real estate that is a fix and flip. It's based on effort, so the income is business income. Rendering personal services is based on effort, so the income is business income. Business income is subject to self-employment tax. Investment income is not. Self-employment tax is Social Security taxes that the self-employed must pay. Those who are self-employed must pay both the employer and the employee share of Social Security taxes, since they are both the employee and the employer. Self-employment tax is paid in addition to income tax, which is why the self-employed pay such high taxes. If there will be business income, then considering one of the following entities which reduce self-employment tax. C corporations. So the net income of a C corporation is not subject to self-employment tax. And net income of an S corporation is not subject to self-employment tax either. Net income in a partnership or sole proprietorship are both subject to self-employment tax, so these entities generally are not used for business income. However, a partnership may make sense if your business will have more than one owner. Planning point number 1. When first starting your business or investing, you may not have a clear answer for the above factors. An LLC can help in this situation because an LLC can change how it's taxed. For example, if you're starting your business and you're not sure how much income you will generate, if you start an LLC as a sole proprietorship or a partnership, your LLC can elect to be taxed as an S corporation or a C corporation at the ideal time for tax purposes. Planning point number 2. If you and your spouse are not the only owners in the business, then consider having the business in a partnership with your interest in the partnership owned by an S corporation. S corporations are inflexible when it comes to multiple owners, whereas partnerships are very flexible in this area. However, partnership income is subject to self-employment tax, whereas S corporation income is not. So, by using both a partnership and an S corporation, you can have the tax benefits of both entities. The remaining 2 factors focus on business income and choosing between an S corporation and a C corporation. Factor 2, how are you going to use the business income? To choose between an S corporation and a C corporation, determine if the income will be reinvested or left in the business or used by the owner for living expenses. If the income is needed for living expenses, then an S corporation is typically used because distributions are not taxable to the owner. S corporations tend to be more efficient for tax purposes when there is a large amount of business income. If the income is not needed for living expenses, then a C corporation could make sense. Distributions from a C corporation are taxable to the owner, so taking distributions for living expenses or other personal expenses may result in higher taxes. C corporations can result in higher taxes if there's a large amount of income, particularly if distributions are taken. For this reason, C corporations tend to work best when there is a small amount of income or the amount of income can be controlled. For example, if your C corporation's only customer was your S corporation, then you can control the amount of income in that C corporation. Factor number 3, your tax rate. Another factor to help choose between an S corporation and a C corporation is your tax rate. If your tax rate is more than the C corporation's tax rate, then a C corporation can make sense. If your tax rate is less than the C corporation's tax rate, then an S corporation tends to make more sense. Finally, deductions. Are there expenses that you're paying personally that, if properly structured and documented, could be paid by your business or your investment activities? If you have such expenses, you've just found the permanent tax savings. Your tax strategy should identify the deductions, how to document them, and who, whether it's you or your business or your investments, should pay them. Because I want you to be able to deduct it all. What if you could make any expense deductible? By converting non-deductible expenses into deductible expenses, you not only reduce your taxes, you also create permanent tax savings. All you have to do is follow the rules and change your behavior to meet the rules. Remember, if you want to change your tax, you must change your facts. But first, let's look at the types of deductions. There are personal deductions and there are business deductions. Personal deductions are available to any person. Business deductions are only available to those who have a business. One type of personal deduction is a charitable donation. Here is a specific strategy for charitable donations. The government wants you to be charitable, so it gives you incentives to donate. But many states have endorsed charities, so when a donation is made to that charity, a state tax credit is given in that exact amount. In other words, you get your money back. In addition to that, you get to take a charitable deduction on your federal return. Since there are very few personal deductions available and many business deductions available, let's focus on the business deductions. There are 4 rules to make any expense a business deduction. Really, any expense can be a business deduction as long as it meets these 4 rules. First, the expense must have a business purpose. Business purpose means it relates to business transactions that are reasonable. For example, let's say a real estate agent meets with the client to discuss a property the client is selling. This is a reasonable business transaction for a real estate agent, so it meets the business purpose rule. Rule number 2, the expense must be ordinary. Ordinary means the expense is typical in your line of business. Different businesses have distinctive customs, and it is relative to the magnitude of the expense and the frequency. For example, a real estate agent takes a new client to lunch to discuss the strategy to sell the client's property. This is a typical expense in the real estate industry, so it meets the ordinary rule. Rule number 3. Necessary refers to how the expense will contribute to the success of the business. The expense must increase profits, prevent losses, or increase market share. For example, our real estate agent takes a prospective client to lunch to close the deal on making them clients. This is a necessary expense because it will increase profits and market share. And rule number 4, the expense must be properly documented. Documentation is the most important requirement because if you don't have documentation, deductions can be disallowed, even if all the other rules are met. For example, when our real estate agent takes the client to lunch, the agent must document all the required items for a meal deduction, which include its business purpose, who was there, the date, time, location, and amount. Finally, keep it going. As you move forward with implementing and executing your tax strategy, you'll discover that your tax strategy is constantly evolving. This makes it important to continually monitor your tax strategy to make sure it is still serving its purpose to ensure that you pay the least amount of tax allowable by law, regardless of your business or investment decision. The best person to reduce your taxes is you. You are in control, and that is the key to reducing your taxes. To do this, you'll need education and a good strategy, and this is where AMZ Accounting can help. So I want to thank everybody for listening to the webinar. You can go to our website, amzaccountingsolutions.com, and you can find more information about us. You can schedule a call with us on the website, or you can use the scheduling link, and we can discuss what's required to set up a tax strategy. And also, there is a freebie download that will help you determine if your deductions are meeting the 4 requirements, and also a tool that will help you calculate your wealth vision. Thanks again.